There is a theory of valuing stocks referred to as the constant dividend growth model. Sometimes referred to it as the Gordon model. But there are some circumstances when company stocks do not necessarily follow this constant growth concept, if you will, of dividends. So we have some tools that we'll talk about in this video of how you deal with variable growth dividends. So let's look at the simplest case. We have a company that last year paid a dividend of $2. Now they normally grow their dividends, are normally growing at, let's just say, 6%. Now, for some reason, this company, maybe they created a new product and they're expecting some increases in cash flows, which will ultimately end up, some of it, going to dividends. So let's say during this super normal growth period, let's say for the next 4 years, the company expects the growth rate to be different. Maybe they expect it to be 10%. And they expect that to happen for 4 years. Now, this company, because of its risk level, has a required rate of return of, let's just say the required return is 9%. So what is the value of this kind of cash flow stream? Well, here's how the process works. We need to find the future value of dividends during the super growth period. And again, there's 4 years of that. So we need to find D1, D2, D3, D4. We need to find these 4 cash flows. Now, the formula for that in Excel up here, here's the future value formula in Excel. We'll calculate those 4 cash flows. And if you notice, it looks it's an if statement. So if this number over here, if this growth period is a certain number, then it calculates its future value. So we got that. The other thing we need to do is we need to figure out what is the price at the end of the 4th year. Well, this formula for price is based on the dividend in year 5. That's why we need to have this normal growth period. What does it grow after year 4? So then it calculates the future price and, of course, then the present value of that future price. It then sums up the dividends in the super growth period. It calculates the present value of the future price, adds those together. So this stock would have a value of $81.48. Now, a complication might be not this 2-step model. What if there are several steps in the growth period? So let's say now we have a company, we have a $2 dividend. Weighted average cost of capital of the company is 10%. Let's say that they have a 5-year variable growth period. And after this growth period, we expect the growth to be 4%, which is what, for this company, is what it normally is. Now, we're going to do this project. We're going to buy something, right? So let's say the first year there's 0 growth. The next year there is 9% growth. Then the next year there's 10% growth. Now, we need to know there's 5 years, right? So 10%, 10%. Let's say this last year we expect there to be 20%. And then it drops back to 4%. So this does the exact same thing. It calculates future value of the dividends and then their present value. It then calculates the price in at the end of the 5th year, which means it calculates in the formula here, it calculates the dividend, D6 in this case, finds its present value. So this stock would have a value of $43.26. So, I mean, we can make this as complicated as you want. There are models, quite frankly, that utilize this type of growth period. Not so much for dividends, but it applies it for free cash flows. But certainly we know that companies, when they first come into existence, there is a life cycle of business. So in the very beginning, they have low growth. But then shortly after this low growth, they're going to have periods where they could have extremely high growth. And then over time, that high growth of dividends might ultimately kind of a wane, if you will. It will reduce to ultimately what you might think might be an industry average kind of a dividend growth. So we could incorporate those things. Now that would require maybe even a little bit more, but I mean, you can see how we could do it. So maybe, the first year is 0, then we have a couple years of 9, we have a couple of years of 12, right? But then eventually it says, oh, now maybe here it's going to be 10. Then here it's going to be 9. Then eventually get down to this 4% growth. So we can see how you can complicate this question if you, number one, if you have the data, how complicated you need to be. Quite frankly, after you get out at 4 or 5 years, the additional present value is really going to add very little to the value of the company at the end. So anyhow, this is what we refer to as supernormal growth stock models or variable growth models. Thanks for watching the video. See you soon.